Entering the second weekend of March, global markets were priced for a precise soft landing. This optimistic valuation ignored underlying friction in the U.S. labor market and the persistence of sticky inflation. That stability vanished on March 14th. The Strait of Hormuz crisis transitioned from a localized friction point to a systemic event as the U.S. Defense Department announced a new wave of military strikes against Iranian targets. The impact on global logistics is concrete. Iranian declarations and subsequent military action have effectively choke-pointed a $20 to $30 geopolitical premium on oil, makes a soft landing for the Federal Reserve nearly impossible to engineer. This is the stagflationary pincer. It is a dual-sided threat that leaves central banks without a viable policy response. The first factor is surging inflation. This massive geopolitical premium on crude forces institutional capital to aggressively reprice baseline inflation expectations across the global supply chain. The second vector is economic stagnation. Surging transport and fuel costs compress corporate margins, effectively halting production in energy-intensive sectors like chemicals and steel. Central banks are now paralyzed. Cutting rates to support growth risks triggering runaway inflation, while raising rates to fight energy costs further damages a fragile industrial sector. The damage is already visible in U.S. equities. The Dow Jones Industrial Average has surrendered its 2026 gains, closing below the psychological floor of 47,000. This crash is driven by an energy tax that disproportionately impacts industrial heavyweights like Boeing and 3M. Rising fuel costs are eroding the profit margins of these transport-dependent firms. The S&P 500 has breached its 100-day moving average, plummeting towards support at 6,550. A death cross, a technical signal where a short-term moving average falls below a long-term one, now appears imminent, signaling a potential long-term trend reversal. The global VIX, which measures the market's expectation of 30-day volatility, has spiked to 27.29. This level indicates systemic institutional hedging, as the cost of insurance against further market declines explodes. European indices are even more vulnerable. Germany's DAX index is hovering just above its primary structural floor, as high energy prices threaten to halt production in energy-intensive manufacturing sectors. Institutional capital is engaging in a broad-based deleveraging of growth portfolios. Investors are moving into cash as second-quarter earnings estimates are aggressively revised downward. In Asia, export-driven economies face a liquidity crunch. Surging logistics costs and supply chain risks are dragging down the Kospi index in South Korea. The Bank of Japan is facing a specific policy trap. They cannot support the yen through interest rate hikes without further damaging an equity market already reeling from higher import costs. India is navigating a similar liquidity pincer. This chart shows massive cash liquidations from foreign institutional investors being only partially absorbed by domestic retail inflows. Technical signs for India's Nifty 50 are bearish. The put-call ratio, a sentiment indicator measuring the volume of bearish put options against bullish call options, has dropped to 0.84 as the 23,500 support level fails. Emerging markets are losing their structural floors. Historically sensitive to dollar strength and oil spikes, these indices are seeing a rapid exodus of foreign capital. With global exchanges closed for the weekend, where is the smart money moving capital in anticipation of Monday's open? The primary destination is the U.S. dollar index, which has climbed past 99.64. This is a geopolitically driven flight to the world's reserve currency. Hard assets are seeing an aggressive return. Gold has reclaimed its status as a historical hedge, crossing back above the $5,000 mark. Bitcoin is acting as a high-beta digital hedge against fiat currency instability. While equities fell, Bitcoin held its ground above $70,000. This shadow market movement in crypto and futures shows institutional capital abandoning the wealth generation playbook. The focus has shifted entirely to wealth preservation. Traders should adopt extreme defensive posturing for Monday's open. The market is still pricing in the risk of sustained military escalation in the Middle East. High-beta sectors like auto and finance remain vulnerable. Tactical capital is rotating strictly into defensive shelters, utilities, IT, and public sector oil companies. Watch Monday morning's industrial data from China. These numbers will dictate regional demand and the price floor for commodities like iron ore. The Hormuz shockwave has replaced the 2026 growth narrative with a mandate for defensive preservation. Until the stagflationary pincer breaks, cash is the only stable refuge.